One of the questions I get asked all the time is, should I get a HELOC or not? Or one of the things that I get asked when I teach on this subject matter is, why should I not have a HELOC? So we're going to go through that today. I'm really excited to share some of these pieces with you because this product has become one of the best financial planning tools I've seen through real estate finance. And I'm really looking forward to you be able to learn from this and utilize it in a very healthy, proactive, and beneficial way for you and your heirs that you are creating this beautiful legacy for through home ownership. So let me share with you a little bit of what I mean here. So HELOCs, what are they? They stand for home equity line of credit. Effectively, it's a means of you being able to give yourself access to your money, right? Right now, let's say if you have a $500,000 house and you owe $300,000, you have $200,000 of your money that you effectively can't touch. So HELOC allows you to have access to it. And it also becomes one of the cheapest ways to access it, right? Because if you have $200,000, how do you take it out? Cash out refi, sell the house, or reverse mortgage. All those typically are going to be much higher costs than a home equity line of credit would be. So it many times becomes one of the cheapest ways to consolidate, to renovate your house, to leverage, to be able to buy a different home. It's you effectively becoming your own bank. In addition, it also serves as an emergency fund. I've seen life scenarios where an unexpected life event took place, and instead of liquidating from reserves that they had invested or savings that they didn't want to liquidate, they used a HELOC because borrowing 20 grand from your HELOC was a much lower payment and something they felt more comfortable with than having to withdraw 20K from their $50,000 savings account, half their savings gone. So it becomes an emergency piece. Another part that many people miss is it becomes legal protection in most areas, right? If you, again, have a $500,000 house with $300,000 loan, pretty much anybody who knows how to get public information can identify what your loan was when you first got the house. They can see what your equity is. And if they want to make you a target of a lawsuit or anything like that, they might be more inclined to do so. A HELOC will now not only show them what the first mortgage is, but it'll show them the limit on the second. So there's less money that they think might be there. So it could deter them from ever going after you. And this is really, really impactful for a resource that is just unseen. Again, some of the life events that I've seen take place is people leverage HELOCs to buy investment properties. People find a piece of land, and instead of paying, a crazy amount of money, they just use a HELOC to buy it. Instead of using hard money, they use HELOCs. It's become really, really impactful. But one of the best scenarios that I've seen for it was it was used as a great tool to create memories in the family of really dear people who were in my life. One of the family members, one of the parents, ended up getting diagnosed with cancer, and the last 6 months of the time she had, they decided to take family vacations and make memories. And instead of liquidating savings, they used a HELOC. And when she passed, her life insurance kicked in and they paid off the HELOC, and the family was left with no debt on the HELOC, a lot of memories. And for them, they felt like that was one of the best moves they could have done in this. And so me being able to see that and testify to it, I can share with you right now, a HELOC can come in handy so much for investment pieces, but also things that are just unforeseen that you do want to make sure you're prepared for. Here's an example of a HELOC, right? So $700,000 house. This is an example at an 80% CLTV. So for those of you who like to know the mechanics of these pieces, let's say you have a $700,000 house and you have a 436 loan right now. So your current mortgage balance is 436. HELOC at 80% CLTV means 80% combined loan to value. So $700,000 is a loan. You take 80% of that. So 700 times 80% equals 560. Then you minus out the first mortgage, 436, and now you get 124. Effectively, assuming qualifications, the tappable or accessible equity in the home from an 80% LTV would be 124,000. Now, I usually get asked, what's the cost of that money, right? And so note that HELOCs work off something called the margin. It's also known as a spread. I like to just identify it as an add-on. So rates with HELOCs are very different than like a 30-year fixed rate, right? Rates with HELOCs are usually based on something different, typically prime. So let's say you are getting a HELOC where it's 0.75 over prime. That means that if prime's at 8%, your interest rate is 0.75 on top of prime. So 8 times 0.75, 8.75. Some HELOC options are even lower. They're under prime. They're subprime, negative prime, 0.5 or something like that. So do keep an eye on that. There's some really good HELOC options. Many HELOCs, if you can qualify, they're usually looking for vanilla. The best HELOCs I've seen with the lowest rates are typically credit unions. So keep an eye out for that in your local credit union. If you don't qualify, that's where a broker like me might come in handy, because we have HELOCs that we can do with different types of income verification. So if you're self-employed having issues, I have some really good options there. And we usually do a little bit different averages and different pieces than a bank does with the very vanilla loans that they're looking for. So a cost for a HELOC would come with the add-on or spread, which would be whatever that is on top of prime. And then typically a maintenance fee of $200 or less. It is a variable rate. So when the Federal Reserve moves their rate, their benchmark rate, and it moves prime, as the index of prime moves, your rate moves. So prime is now 7.5 plus 0.75 is going to equal now 8.25, right? So your rate can go up or down. And for the first 10 years, it's an interest only payment. After year 10, it turns into a principal and interest payment. So then you're now going to be paying off the amount of money you still owe. So if you had 124 and you borrowed 24, and at year 10 you owe 15, that 15 now gets amortized for the remainder of the 20 years. If you're like, well, I don't like that, I just wanted still to keep my interest only, you most likely could just refinance a HELOC, get into another 10-year IO or interest-only loan. So variable rates would apply there. So 124 line of credit, $30K you borrow at 9%. Let's say 9% is the rate with prime and all those pieces. It's $225 a month. So if the rate goes up to 10%, it's $250. So do know that these rates are higher and they seem intimidating to individuals, but just remember you're borrowing typically a lot less. And because you're borrowing less, it gives you more flexibility to have a lower payment for the money you borrow. With all that said, that is a HELOC. So I hope that was helpful for you. And if you have any questions on this, let me know. Excited to help any further. And I truly do hope that it becomes a great tool for you. And I hope you walk away from this, like many other people who've gone through this presentation, going, why should I not have one? If it doesn't cost me a lot and it gives me access to my money so that it's not frozen away from me. If there's an opportunity in life that comes disastrous or opportunistic in a positive way for investment, why would I not want to have access to my money so that I can use it? Those are great questions. Hope the answer for that is you should go talk to a credit union now to see what some of that looks like, or reach out to us so we can help you there too. Thanks so much. Have a good one.